Hey everybody, this is Mr. Birchall. Just wanted to give you a quick update on stocks and how they all work. Couple of basic things. I'm going to have you go to MSN Stock Loser. Search Google for that. You're going to get most active stocks, MSN Money. Good website. A lot of cool tools that will help you out. There's gainers, things that have made money today. There's losers. This is my best friend when it comes to stocks. I want to see stocks that lost money. I want to look at why they lost money. And if it's a stupid reason where people made emotional decisions and sold stocks, but really the fundamentals of the company are still there, this is what I'm looking for. I'm looking for a stock that's doing really well but had a bad day. And in the gainers, I don't usually look at the gainers. The reason is that if it's gained significantly, I probably have already missed the opportunity. For example, the very first one was a penny stock. Penny stocks means that it's worth less than $1. They typically are very small companies, and penny stocks are very, very risky. This one, if you're looking at it, you're noticing that the last thing that happened, it was $1.43. That's how much it was worth. Anything worth like $1 or something in stock language is usually a very small company, really risky. But if you also look over here, you notice that the change is $1.28. It started out at what, 25 or 15 cents this morning, and now all of a sudden it's $1.43. It's come up almost 900%. So if you had $1,000 in this stock last night, today you have $9,000 almost. So that is really good if you've already been in there. But the fact that we don't have stock in that company, or at least I don't, means that I probably already missed it. It's probably too late. If I buy in now, the chances that it will go down are much better than the chances that it will go up. Here's the deal with stocks. When you buy a stock, you are actually buying ownership of a company. So if a company has 100 shares that they've made, if you buy one share, you own 1% of that company. If you buy 50 shares, you own half of the company, and if you bought all 100 shares, you would actually own the entire company. Now, in the stock world, you're not going to just buy one stock. If there's a company out there that has 1,000,000 stocks and you buy 1,000, then you own that much of the company. If each stock were worth $1 today, but then all of a sudden tomorrow they are making more money, that stock is worth more then. And so if it all of a sudden, instead of being worth $1, is now worth $1.50, guess what? If you go to sell your 1,000 shares, you're going to make $1,500 back, which means your profit is $500. You had $1,000 that you put into the company and bought 1,000 shares. You sold it for $1.50 per share, and you had 1,000 shares. So that means you have $1,500 worth of stock. You sold it, you got your $1,500, your profit is $500. That's how the stock market works. There's two ways to play the stock market. One, actually there's a lot of ways, but there's two main ways. One way is to do it short term, which is called day trading. It means that you buy a stock today, you might sell it 10 minutes later. Maybe you'll sell it 3 days later, maybe you'll sell it 10 days later. Those are short-term investments that are not going to last long. The risk is much higher. However, a lot of people make a lot of money fast by day trading. The other option is more of a retirement plan where mutual funds we talked about, the Roth IRAs, the 403bs, where you are, or 401ks, where you're buying stocks, but those are stocks like GE, IBM, Ford, McDonald's, the big companies that are really stable. They're going to make money over time, but it's going to be a slow process. You're not going to get rich, but you're going to make money, and it's going to accumulate. It's just going to take a long time for that to happen. The risk is much lower. It's not to say that you can't lose a lot of money in those big companies. You certainly can. They can go out of business just as well as a small company, but the chances of it happening are less with a bigger, more stable company. This company, I just have to click on it out of curiosity because this is crazy. It started out at 15 cents, and here's the graph. I want to see what did this look like over a 3-year period. And when I look at it over a 3-year period, what am I going to see? There's probably not a lot of data, and in fact, there's no data. So I'm not really sure even what this company does. There's not a lot of information on it. I can go to the historical prices over here. I can try to look at the profile of the company and see what it actually does. It's not listing anything. So it looks like it may be a company out of South America. So commercial. I'm not really sure what it would be, but in any case, pretty risky stock that's made a lot of people money very quickly here. But I think we probably missed it. In any case, let's look at a different one. I'm going to go down to losers, click on Avid. Avid went down 17% today. And if you look at this, I'm going to go to the 3-year chart because I want to see how's this doing over a longer period of time. And for 3 years, Avid has done fairly well, up and down, which as a day trader I like. As a long-term investment, I don't like. I'm also going to look if it's got a rating. This one doesn't. I'll show you that in just a second. Again, you're going to want to go to the profile of the company, find out what they make, what they do. You're also going to want to go down and look at the news on this, which headlines would be right here. And you're going to look at key developments. Why is this going up and down? If I look at it, it's going up okay, but it really dropped here. So I'm not sure why that would be. Let's look at it for a month. A month it's gone pretty flat and then straight down. 3 months it's gone up a little bit and straight down. I still might buy this, knowing there's quite a bit of risk. If it bounced up to 9.75 or 10, I think I would sell. I would be doing it as a short-term investor. Now, one thing I did want to show you is you can look at the news and you can look at the rating on these companies. There's the rating. And here's the news. The rating is a 4 out of 10. Not so great. If you find companies that are 8 and 9 and 10 out of 10, it means they don't owe a lot of money and they're making a lot of profit. That's good. If you also read these articles, it's going to tell you not only what the company does, but it's going to tell you if things are going well and what the future prospects of the company are. And that's pretty much it. Long-term investment, you're looking for big companies that are stable. And you can see the price just changed as we were watching it. Short-term investment, not so good companies could be real money makers, but you still want a company that has low debt, so they're fairly stable, and the price is going to continue to go up. But you want to look for opportunity. Did the price dramatically drop, or did the price dramatically go up? And if it did, why did it go down? Why did it go up? And do I think that it will bounce even higher from wherever it happens to be? So hopefully that clears up some things about stocks for you. Good luck. Send me a message if you have any questions.